This Week in Economics on the 9th of April 2016. A numbers man here. We have a number of things. We'll be looking at the Fed meeting, the minutes of the meeting, and where the consumers in the economy stand. And we'll also look at the University of Michigan's Consumer Confidence Index and various other tools that the Fed uses in looking at the economy. One of the an interesting item here, we talked about this before, we now have much better data sets than we did at one time, big data. That being said, we still are many times miss the mark, so to speak. We'll start at the end of the Fed meeting, their minutes, and this is the forecast uncertainty. And on the other leg of the broadcast, we'll look at the British economy, particularly where it stands in manufacturing. A report there from their Bureau of Statistics. So we have quite a bit of territory to cover here, and we'll also look at gender issues and what it actually costs the economy in terms of what is now referred to as labor not compensated for women. We try to use a broad umbrella of indicators. We'll also do a special report on Dodd-Frank. In the current political campaign, Bernie Sanders, the Social Democrat, has been talking about it and how it relates to the banks, in particular the big banks. And we'll look at that in a special presentation because much of that work depends on interpretation of, I believe it's section 114, and don't count at 146 anyway, nonetheless, and also on legislation to redeploy a Glass-Steagall type law that was first enacted, Glass-Steagall, under Franklin Roosevelt. And of course it was tempered down under Ronald Reagan, and finally its demise under President Clinton. So those are some points. We'll have to do it in a special broadcast because we need to go at it from a number of angles. There was a recent interview with the Daily News that Bernie Sanders did, where he talked about it from a rhetoric standpoint, primarily what you do on the campaign trail, not into specifics. And one of the reasons, obviously, for this, there's a lot of disagreement as to interpretation of the Dodd-Frank legislation. Much of that is placed upon the table at the Fed, and that is what is traditionally called rulemaking, which in itself is a different situation. As the American politician Harry Reid said, the devil is in the details, but we'll go to what we basically know here. This is a forecast uncertainty, is what they title this section. This is the last section of the report. The economic projections provided by members of the Board of Governors and the President of the Federal Reserve Banks inform discussion of monetary policy among policymakers, can aid the public understanding of the basis for the policy action. Considerable uncertainty attends these projections. However, the economic and statistical models and relationships used to help produce economic forecasts are necessarily imperfect. Descriptions of the real world, the future path of the economy can be affected by a myriad of unforeseen developments and events. Thus, in setting a stance of monetary policy, participants consider not only what appears to be the most likely economic outcome as embodied in their projections, but also a range of alternative possibilities, the likelihood of their occurring and of the potential cost to the economy should they occur. Now, this is more of a modernistic type of interpretation here, and very straightforward. We'll append this on the to the show notes, including in these reports in the past, monetary policy reports, and those prepared for the Federal Reserve staff in advance of meeting. This is the Open Market Committee. For example, suppose a participant projects a real gross domestic product, GMP, and the total consumer prices will rise steadily at an annual rate, irrespectively of 3 or 2%. If the uncertainty attending those projections is similar to that experienced in the past, the risks around the projections are broadly balanced. The number of reported, and this you don't see the table here, so we won't get into that, with probably a probability of about 70% that actual GDP would expand within a range of 1.4 to 4.6% in the current year, or 0.9 tenths to 0.5 to 5.1% in the second and third years. The corresponding 70% confidence interval for overall inflation would be 1.1 to 2.9% in the current year, and 9 tenths to 3.1 in the second and third years, because current conditions may differ from those that prevail on the average over history. Participants provide judgments as to whether the uncertainty attached to their projections of each variable is greater than or smaller than or broadly similar to typical levels of forecast uncertainty in the past. Participants also provide judgments as to whether the risks to their projections are weighted to the upside or weighted to the downside. Are broadly balanced. That is, the participant judges whether each variable is more likely to be above or below the projection for the most likely outcome. These judgments about the uncertainty and the risk attaining each participant's projection are distant from the diversity of participants' views about the most likely outcomes. Forecast uncertainty is concerned with risks associated with particular projections rather than with divergence across the number of differences. Let me get my pointer down here, of different projections. As with real activity and inflation, the outcome for future paths of federal fund rates are subject to considerable uncertainty. This uncertainty arises primarily because each participant's assessment of appropriate stance of monetary policy depends importantly on the evolution of real activity and inflation over time. If economic conditions evolve in an unexpected manner, then the assessments of the appropriate setting of funds rate would change from that point onwards. In other words, very pragmatic view here, a mix view that is being leveled. And back to the corresponding 70% of confidence interval for overall inflation, we'll get to where inflation should be. Let me just quickly flash over here to the what are the expectations for medium FOIC participants' target fund rate. This is from the New York Fed in the summary of economic projections they call STEP. Federal fund rates year in. This is 2016, 25 basis points here would be at 1%. That's the end of this year. 2017 at 2%, 2018 at 3%, and the long run at 3.5%. This would be for the bigger banks. Now, the medium here would be 1.13%, and that's 2016, and 2.13% for 2017, 3.10% for 18, and 3.50. Now, these are just some of the expectations here as what would be expectation for medium FOIC participants, economic predictions in the summary of the economic prospects. Several respondents anticipated FOIC participants' economic projections for 2016 would be adjusted in response to recent data released, with several dealers, this is the dealers, noting that their expectations, medium participant forecast for 2016 GDP growth would likely decrease, and several also suggested that the medium of their forecast 2016 headline or core PCE inflation would increase slightly. Now, that is a big argument. Dr. Fisher and some others think that it will. Others, it'll be below their expected target of 2%. And the data tends to move in that direction. Monetary policy expectations. Several respondents expected the committee to upgrade its assessment of current economic activity into headline ongoing improvements in the labor market. Several respondents also suggested that the committee would acknowledge an upward rebound in market-based measurements of inflation compensation, or alternatively note that these measurements remain lower rather than decline further. Several respondents expected that the committee would indicate that the survey-based measures of long-term inflation expectation remain low. Now, this is one side of the argument. Declined slightly over intermeeting periods. Several indicated that the March FOIC statement would reference global economic development. We'll get to that in a second here. And several expected a few significant changes in the March statement. Now, this is the response to survey of market participants. This is distributed on the 3rd of March and on the 7th of March here. This is from the Fed, the Reserve Bank of New York, March 16th. This is the response to survey of market participants, market group there. And hear a lot about that. Let me get back to the start of this. We're down at the conclusion. Survey of economic projections here, medium participants. We can skip around a little bit here. Projections of federal fund rates in the long run move lower. Range of estimates from the long run rate was on change in December. Hence, with all participants anticipated that inflation would eventually reach the objective of 2%. The range of participant judgment long-term level of real federal fund rate was on change from December at 1% to 2% there, and basically the long run real rate would be at 1.25, down 0.25 percentage points from December. So things are changing a little bit here. The average historical projection area, well, anyway, this is, we won't get into GDP. Uncertainty rises. We talked about that. We're going up the report towards the beginning of it, been going in the other direction, but it's not, doesn't matter that much. These notes are released, and you'll have it appended there so you can look at it for your own perusal, complete with charts, etc. It'll all be there hanging out. Outlook for inflation. This is PCE price picked up to pick up in 2016, to rise in February 17, 18, nearly all expected PCE price inflation to be at or very close to the target 2% rate. However, relative to December's, most all participants marked down their projections for PCE price inflation in 2016. Observing the decline in energy prices since, and we'll get to that when we do the numbers, the end of the year, continuous strength in the dollar. Appropriate monetary policy relative to December, the projections of appropriate level of funds rate over the next 3 years. We went over that. This will be in 2016, both at 0.50 to level off at 0.88%, and 1.88% respectively. And it will fall 2.5% and to 3%. This is the federal fund rate, the long-term federal fund rate. If you recall the letter that Rev. Nader wrote to Chairman Dr. Yellen about pensioners and raising of interest rates. Well, they will rise, but in 2-3 years or whatever, perhaps to 3%. But that's contingent on the economy moving along at somewhat normal pace. Now, when we say somewhat normal pace, what we mean is, if you look at the historical, you'll have problems. The outlook for economic activities, a substantial majority of participants expect that conditional on market assumptions and appropriate monetary policy, real GDP in 2016-17 would decrease at a rate above the individual estimates of the long-run normal growth rate before decelerating at a pace at or near their individual estimates. That says it all, doesn't it? In other words, they are not getting out on the boat. Summary of economic projections for each year from 16 to 18, and on the long run, each participant projections was based upon information available at the time of the meeting. Normally, appropriate monetary policy is defined in the further path of policy that each participant deemed more likely to foster outcomes for economic activity and inflation there. All participants regard the level of uncertainty, and this is the core sentiment of this entire report, and the unemployment rate is broadly similar to the norm in the previous 20 years. Shared a similar view regarding the uncertainty surrounding their inflation projections. Participants were about evenly divided as to whether they judged the risks of their forecasts for real GDP growth to be weighted to the downside or broadly based. No participant saw a risk to real GDP growth weighted to the upside. Participants thought that the risks to the outlook for real GDP were skewed to the downside than to the upside. And let's continue up the report here, and we'll voting, of course, with Chair Yellen and the usual suspects, as one would say, to leave the target rate unchanged. And the basic consensus is there will be 2 or 3 more rate hikes, perhaps this year, and they will not amount to much. About 1% will basically be where they will end up. Go to the survey of consumers, because consumers, interesting situation, excluding energy and a few other things, automobiles, the retail trade group were at substandard levels in the month of February and the March figures. Now, this is consumer confidence for March at 91. This is from the University of Michigan. It was at 91.7 in February, and in March of last year was slightly higher at 93. Current economic conditions at 105.6 in March. In February of this year, it was 106.8, and in March of last year, 105. The index of consumer expectation, 81.5. It was 81.9 in February, and in March of last year was 85.3. This is from Dr. Curtin. He is the chief economist there at the survey. Consumer confidence inched up in late March due to more favorable economic expectation, but the gains still left the sentiment index slightly below last month's level. Despite recent small monthly variations, the overall level of confidence has remained largely unchanged during the past 9 months. The sentiment index in Q1 of 2016, 91.6, barely differed from 91.3 in Q4, or of 90.7 in Q3 of 2015. This stability reflects more positive personal finances being offset by less favorable prospects for the economy. Indeed, consumers were more optimistic about their inflation-adjusted income expectation than at any time since before the Depression 2007. Consumers anticipate that the slower pace of economic growth will more than likely put an end to further declines in unemployment rate. What was surprising was the expectation of higher gas prices and higher unemployment have not caused an increase in uncertainty about personal financial prospects. To be sure, the positive outlook for consumer spending is contingent upon a view held by most consumers that the jobless and inflation rates will be maintained close to their current levels. Overall, the data is still indicates a 2.7 rate of growth in personal consumption this year. Basically, it's kind of an interesting situation. Basically, what's happening here for consumers that have not been made redundant are consumers that feel the chance of being made redundant this year in 2016 are not as great. They are moving along with their personal financial situation, and we saw in previous years that paying down as the Depression moved in 2008, and when the Obama administration set up their economic house in 2009, credit card debt, as jobs were falling off the planet, credit card debt was high, and then, of course, what consumers did was took advantage of various, what we used to call priming programs to pay down their credit cards and mortgages respectively, and of course some refinancing in previous years. So now the consumer has a better handle on their finances, out and in income. In other words, what is coming in, what is going out, is so to speak. So now we see a totally different situation involving in the retail sector, particularly clothing and that sort of thing. If consumers have those supplies on hand, they're not buying new supplies. However, they are going out to eat more on a more regular basis than previous years, and to a drinking establishment, what they call a disposable income. So they're paying mortgages, rents, etc., and buying less clothes, period. So this in itself, on an economy that's 70% consumer-based, changes the reality of things drastically. Let's go to the gender part of the program here. We spent a little, let's get Wells Fargo while we're here. Admitted to deception in $1.2 billion U.S. mortgage accord. They settled a record $1.2 billion settlement with the Department of Justice. The largest, Wells, the largest mortgage lender and third largest bank by assets. It was filed in Manhattan. Accordingly, admitted knowledge and accepted responsibility for having from 2001 to 2008 falsely certified that many of his home loans qualified for federal housing loan insurance. So much for Wells Fargo. Now to the agenda part we've been wanting to get here. And this is from McKinsey & Company, The Power of Parity, Advancing Women's Equity in the United States. Every state and city in the United States has an opportunity for gender parity, which would add about $4.3 trillion to the country's economy by 2025. The U.S. could add $4.3 trillion in annual GDP by 2025 if women attain full gender equality. In the report, Power of Parity, Advancing Women's Equity in the United States, the McKinsey Global Institute finds that every U.S. state and city could add at least 5% to GDP in that period by advancing potential of women. Half of U.S. states have the potential to add more than 10%. The country's 50 largest cities increase GDP by 6 to 13%. Will appends the study. Or barriers hindering women from full participation in the labor market make it unlikely they will attain full gender equality within a decade. The report finds that in the best class scenario, in which each U.S. state matches the federal with faster rates of improvement towards gender parity and work over the past decade, some $2.1 trillion incremental GDP could be added in 2025. This is 10% higher than business as usual scenario. Achieving this potential would require $475 billion more capital investment in 2025 to create 6.4 million jobs needed to secure the boost to GDP and improve productivity. About 40% of the potential could come from narrowing the gap between men and women who work part-time and full-time, and another 30% could come from changing the mix of sectors in which women work to increase employment in more productive ones. Worldwide, enhancing women's economic potential has gone hand in hand with achieving greater social gender equity. For this reason, MGI has taken a broad view of gender equity in the United States. I'm going to skip here a little. The 10 indicators were used to develop a state's parity, which indicated distance from gender parity in all 50 states. State parity scores range from 0.58 to 0.74 on a scale of 0 to 1. They also developed a model for 50 metro areas. Action by individual organizations, collaboration amongst them are both required to accelerate change. Businesses can promote gender diversity in their own organizations in areas such as recruitment, performance evaluation. Governments can consider ways to make paid leave and improve child care a reality for more men and women. So that is that report. We'll go now to the BBC as we wrap down things here. These things always take a little bit more than could be. Nonetheless, the UK industrial output, we talked about manufacturing here. This is from the Office of National Statistics. Figures show manufacturing output fell by 1.1 in January, down from 1.8 in 2015. The weaker than expected figures have raised fears over the performance of the UK economy. Separate figures show that the UK trade deficit in February was also worse than expected. What the BBC calls a double whammy. The February trade and industrial production figures both provide a double whammy of very disappointing news for the UK economy that bodes ill for first quarter growth. That is from the chief economist at IHS Global, Howard Archer. He reinforced our belief that GDP growth will have been no better than 0.4% quarter on quarter in the first quarter, down from 0.6% quarter on quarter in Q4 2015. The National Institute of Economic and Social Research said it estimates GDP suggests that output growth at 0.3% in the first 3 months of the year, would be Q1. The weakest growth for the UK economy since 2012. Subdued growth in Q1 of 2016 has been primarily driven by weakness in production industries, especially manufacturing. The volume of industrial production is currently 10.7% below its pre-depression level. In my word, they call it recession of 2008, while the GDP has surpassed its pre-recession peak of 7%. The ONS says that manufacturing output has decreased between January and February in 11 of 13 manufacturing subcategories. The biggest decline came from manufacturing of transport equipment, steel input, poor performance in steel sector, and that is something that goes from China, slid, manufacturing of iron and steel by 37.7. That is all the way from UK to Brazil to China. Compared with the same time last year, this contributed to a 0.4% fall in total production output. The Chancellor of the Exchequer, Osborne, will have been expecting a slight drop in today's manufacturing production figures, especially amidst the steel the steel giant tatter. Global steel prices isn't the only issue hurting manufacturing production. The rapid approach of the Brexit resolution there is also coming up. Trade gaps widen. The trade deficit was at £12 billion in February. This is narrower than the upward revision of £12.2 billion in January. The total deficit figures for January is now at £1.8 billion. And meanwhile, British trade gap with the EU widened to a record level, £8.6 billion. The latest figures are disappointing. That's from David Kerr, he's chief economist at the British Chamber of Commerce. We'll leave it there and move to do the numbers. Thus, we see from the notes of the Fed Open Market Committee to the consumer price numbers out of Michigan, consumer confidence numbers out of Michigan, to the UK economy, that it is basically a slow pace. And also the information from the deal desk at the Federal Reserve Bank of New York, which is the principal engine of the Federal Reserve, that part of the economy. Look at it as you have the Federal Reserve, obviously, that is in charge of the overall economy, both in terms of monetary policy and also in terms of employment stability, from Humphrey Hawkins in the U.S. And at the same time, you have the markets, which you're getting into now. The BBC Global 30, this is on Friday, unless otherwise noted, at 39.60. The FTSE All Shares at 34.39. In Amsterdam, 5.43. The DAC was at 91.64. In Paris, they were at 57.21. In Brussels, 34.007. In Madrid, 134.70. In Zurich, 56.20. In Moscow on Friday also, 19.42. And in Johannesburg, they were down, negative 294.82. And as we move along here, Bombay, they were also down 226.79. In Karachi, 71.51. In Lahore, they went in negative, also 45.11. In Colombo, 45.43 on Friday. And on Wednesday in Tehran, they were down 213.09. In Sydney on Friday, down 24.30. The Nikkei at 70.68. The Hang Seng in Hong Kong at 104.36. In Shanghai, they were down 23.46. In New York, 35. The Nasdaq, 2.32. And the Merck out in the Midway city of Chicago, that is the commodities market, 5.69. In San Pablo, 1,009.83. And finally, in Mexico, they were down 192.67. And on to commodities. Brent crude futures. They were up $2.36. That also pushed the market up in the U.S. at $41.78. The spot was up $2.96 at $41.89. West Texas Intermediate was also up $2.27 at $39.53. That's based upon some shortages out there, but in the U.S. that doesn't do anything for the fracking industry at all. They have to at least be at 50%, and in the last report we talked about accumulating bankruptcies in that sector. Gold was down $2.50 at $1,235. That's on the Forex. Dubai was up $17.20 at $1,242.20. And we'll fly down here to Euronext Life Futures. Cocoa was up $16. Coffee futures were up $19. Robusta coffee. White sugar futures were up $7.40. This is the function of commodities, very speculative situation. We suspect that the rise in crude oil futures is somewhat on conditions of market, but also on speculation. So we'll see how long these prices sustain. The Bloomberg Commodity Index, this is all for the BBC, at 79.03. That's up 1.58. That was on Friday. And this will do it for us. So thus commodities gave rise to the market in the U.S. The markets had a good day, as one would say, overall in the U.S. The BBC headline here, and we covered this, Industrial data raises growth fears, no doubt about that, and service growth remains subdued. We didn't cover that. We'll catch this very, very quickly here. Now this is in the UK. This is the latest market service purchases index. It rose to 53.7 last month, up from February's 52.7, above 50. Confidence in the doldrums. The performance of the service sector is important to UK. It accounts there for 3/5 of the economy. Similar surveys from market released in the past few days have indicated that both UK manufacturing and construction sectors experienced subdued growth last month. From Dr. Chris Williamson, the upturn in pace of the service sector growth in March was insufficient to prevent the PMI survey from collectively indicating a slowdown in economic growth in the first quarter. The survey pointed to a 4/10 increase in GDP, down from 6/10 the closing of last year. Business confidence remains in the doldrum as concerns about global economy continue to exacerbate by uncertainty at home and never unsettled issues such as Brexit and the prospects of future government spending cuts announced in the budget. That's from Dr. Williamson. Therefore, it seems unlikely that March's upturn in pace of growth represents the start of a long-term upsurge. In the context, the survey suggests that growth is more likely to weaken in Q2. The market survey found that growth in new business in the sector during March hit the slowest pace since 2013. Very interesting situation. Q2, traditionally, as in Q1, Q2, you go into the summer months. In many contexts, you usually do not have a lot of growth. Now, in the U.S., you'd have such things as travel, holiday growth, depending on the condition of consumers, and the condition of consumers is better this year than in many years. This will do it for us, for those in business. Make it a productive next week. For the consumer, keep your eyes on the prize. And from the Fed Open Market Committee minutes, evidently consumers have been doing just that, dealing with basics, using their disposable income in ways that enhance their good. As I think the late President Johnson said, their leisure. So, consumers and leisure. Good day.